All right. Hello. Hope you and your family are staying safe and healthy right now. I wanted to do this video just for you. I know a lot of people are wondering what to do right now, what to do with the election, what to do with the pandemic, and how are you, and are asking the question, how are your investments doing? How are your accounts doing? Are they up? Are they down? Should you be making some changes right now? Also, why aren't they recovering as fast as the S&P 500 is? So we're going to talk for about a half hour, get all your questions answered so you have peace of mind. Let's jump right in. I want to start with a study of, to give some perspective of what's going on right now, and then we're going to dive deeper into today's specifics. So here's a study of the market going all the way back to the 1980s, and all the events that happened in the 80s, the 90s, and even to 2000s that's caused market volatility. Back in the 80s is when President Reagan got shot. Like people might remember the disaster of the Challenger, the San Francisco earthquake, Black Monday, the single worst day for the stock market. And even going into the 90s, the Oklahoma City bombing, government shutdowns, impeachment trial, Russian bond default, lots of things to worry about. And this year, remember the 2008 recession, the Great Recession, they're calling it, the credit market, oil prices spiking, the tsunamis and hurricanes, and even the war in Iraq. All reasons to be concerned and create uncertainty and worry in your investments accounts and wonder what to do right now. Should you sell your investments or not? So this here is a study of if you put $10,000 in, and if you just stayed in your investments during all of that uncertainty, if you were just patient and disciplined, just left it in there, versus this other person is someone who actually timed the market pretty well, is every time the market went down, they moved their money out of their investments and into just basically short-term bonds. And short-term bonds are risk-free returns, usually very slow and steady returns. So you can see the person who just stayed in and was able to remain patient and disciplined had a lot of rides along the way, but their $10,000 over 30 years would have turned into $250,000. And the person who was in the market, every time the market went down, they moved it over into short-term bonds, and then after a year, they moved it back into the market. So they actually timed the market pretty well. And in their scenario, they would have only grown to less than $150,000. So this is really important perspective of what to do right now. While we have this major pandemic, a big important election looming on us, is a lot of people are asking, should we be selling our investments? Should we be staying in? What should we be doing? And now we want to talk about your specific investments. What should you be doing right now? So, and also compared to what people are calling the market. And what the people call the market is generally the S&P 500, which is the 500 largest growth stocks in the United States. So I want to draw some comparisons to what you are doing right now with your diversified investment strategy versus the S&P 500 to help answer some questions that you may have concerning your account. Is it doing well? Is it not doing well? How can we make it do better? What should we be doing right now? Kind of things like that. So let's take a look. This is an analysis basically on the S&P 500 versus the way you are diversified in your investment account right now. So this sample client mix is the S&P 500. So S&P 500 is all large U.S. equity stocks. So largest 500 companies in the United States, all large growth companies. On this chart, this is all the different types of asset classes you could be invested in. There's 4 different types of bonds or fixed income. There's 4 different types of U.S. stocks you could be invested in: large companies, value companies, and small companies. And international, we have separated between large companies and small companies. So your account is personalized to you and your risk tolerance. I can only fit 4 on these accounts, but your account is somewhere between very conservative to all the way aggressive. So think about how you're invested right now, whether you're growth and 75% stocks and 25% bonds or aggressive, and you can be able to compare what you're doing right now. So the S&P 500 all is in large growth stocks. People think it's diversified because it's in 500 companies, but really it's in one type of asset. So let's take a look at how has that performed over the course of history. And then we'll take a look at how it's compared right now. So going all the way back to 1973, here is what your current investment accounts would have done. 1973, 1974 was a recession where we would have had bad returns. If you were invested more conservatively, you would have lost less money, but then you could see there would have also been less of a rebound. The more aggressive you were, the bigger the dip, but also the bigger the recovery. So one thing we want to look at when talking about investments is what's your return and also what's your risk. It's just very important to understand both of them. Return alone doesn't really tell us how well you're doing your investments, because what if you have a low return? Does that mean you're doing bad? Well, no, not if you're taking very low risk. Or what if you have a really high return? Is that good or bad? Well, it really depends on how much risk you're taking. If you're taking an exorbitant amount of risk and you're getting a 10% return, that actually might not be that good. So S&P 500 has averaged about a 10% return. Standard deviation is how we measure risk. So you're taking about 17.5 points of risk. All right, in comparison, if you are a conservative investor, and you have 25% in stocks and 75% in bonds, your risk is really low, about a third of the amount of risk. And because you're taking less risk, you're going to have a lower return than S&P 500. If you are very aggressive, you would have a little bit more risk than the S&P 500, but you would also be getting more return. Now, when you're very well diversified, also what you can do is get lower return, or a higher return and a lower risk. So 17 points of risk, if you're in the growth model, you would actually have less risk and more return. Or for almost the same amount of return, about a 10% rate of return, you could take, rather than 17 points of risk, a lot less risk, almost half as much risk, and get about the same return. So that's why it's important to be really well diversified and not be in just one asset class like the S&P 500. And what we're going to see next is you would have been rewarded for that diversification. So what this next chart is going to show us, if you invested $100,000 back in 1973 in the S&P 500 and left it there, how much money would it have grown to? Versus if you invested conservative, diversified, or all the way to aggressive in a diversified account. So all the way through 2019, if you put $100,000 in the S&P 500, it would have done pretty well. It would have grown to $10 million. Nothing wrong with that. But for less risk, you could have also had it grown to over 16 million. Right? Or if you're willing to take the amount of risk, but just be really well diversified, you could have also had it grown to 25 million. So that's why it's really important to know what you're doing and why you're doing it, and to be diversified, to potentially lower your risk and increase your return. All right, now let's take a look at what's happening right now. So Morningstar is a third-party investment information company. So what you'll see here is all those different types of investment asset classes. So for example, large value, large growth, core would be like a blend of the two. So you have large companies, middle-sized companies, and very small companies. And this would be small value and small growth. So today's October 20th. Today, small value outperformed every other asset class. All right, so what we're saying is you want to be diversified between all these different asset classes. We don't know in a given day, month, or even a given year which one of these is going to do the best. So today, you would have been better off in small value. Now let's take a look at the last year. So think about what's going on right now. You have this pandemic that's shut down a lot of the economy. Do you think that would hurt small companies more or is that going to hurt large companies more? Well, if you look at the last year, look how these change. Look at the difference between the asset classes. So growth companies actually did well. So think of companies like Amazon, very large companies like Microsoft, technology companies that have actually been able to benefit during this coronavirus pandemic. Is they've skewed the returns. Is an S&P 500, almost 5 of the companies have the majority of returns in that index, and almost 80 to 90% of those companies actually have negative returns for the year, but a very small handful of very large, almost technology-oriented companies have had great returns for the year. So it's a little bit concerning because the overall economy and most companies are actually not doing that well, but the S&P 500 this year has actually done really well because of just a few very large companies have had really exorbitant returns. So if your account's diversified in all these different types of asset classes, you're going to be trailing large growth or S&P 500 this year, because small companies have gotten hurt more so than large companies. And in your account, over the long run, as we're going to look at some science, that's also going to show us that small value companies over the long run outperform. However, right now, small value companies are actually being hurt the worst. So let's now look at a 3-year time frame. You're going to see things are coming back to closer together, but still small value has been significantly underperforming large growth. Okay, and even during a 5-year time frame, large growth has been the best performing asset classes over the last 5 years, while small value has been underperforming. So let's go back and take a look at how you're diversified invested right now. So S&P 500 would be an all large growth. And this year, in the last 5 years, that's been the best performing asset class. Let's just compare it to aggressive. That's the one that's kind of closest to. But if you're invested in aggressive, of all your assets, only 7.5% is in large growth. All right, there's a lot more in value, and you can see a lot more in small, and a lot more specifically in small value. So your account is underperforming right now because you're diversified and you're tilted more towards value and more towards small and less in large U.S. growth. And you also have a much larger portion than S&P 500 in international. And international has been trailing the last 5 years. So you might be asking, well, why am I not in all large growth? Why am I in so much small value when it's not doing that well the last few years? Well, let's take a look at that. All right, sorry, I'm just trying to bring this up. Bear with me for just a minute. I just got locked out. We gotta get back in. Okay. All right, so let's look at what academics tell us about this. Is what the academics have tell us is over a long time frame is we should be investing more in stocks up to your risk tolerance, and value companies outperform growth companies over the long run, and small companies outperform large companies over the long run. And down here, they did a study. Let me just blow this up a little bit. It's from 1926 to 2014. If you put just $1 in each one of these asset classes, $1 in small companies would have grown to over $18,000. And large companies would have only grown to $5,000. And in bonds, it would have only grown to $135. So this is one reason why you're diversified and invested more in small companies than large companies, because over the long run, is small outperforms large. So when we look at the long run, for example, the stock market beats bonds over a 15-year time frame almost all the time. However, when we look at shorter time frames, The stock market only beats bonds 70% of the time. So it's 30% of the times that bonds are going to beat the stock market. Small companies beat large companies over 80% of the time. But when we look at short time frames, small companies over 1 year time frames only beat large companies about 60% of the time. So that means there are 40% of the time when large companies are going to beat small companies over the short run. Long run, we have the odds in our favor, if you will. Value companies beat growth companies. Look at this, over 95% of the time over the long run. But when we look at things with a short time frame, again, growth companies beat value 40% of the time. So this is one reason why I'm always stressing, think about the long run. We can rely on data for the long run, but in the short run, it's much more unreliable. So let's take a closer look at that. Okay. Here's one of my favorite graphs to look at. So let's say we invested $100,000 back in the year 2000, over the last 20 years. Okay, here's all the different types of asset class you could have been invested in. These are short-term bonds, long-term bonds. This is the S&P 500, small companies, value companies, small value, international, and international value. So if you invested $100,000 back in the year 2000 for 20 years in the S&P 500, your $100,000 would have grown to $322,000. Now let's say you invest that same $100,000 back in 2000 for 20 years in small value companies. What would that $100,000 have grown to? Wow, quite a bit more. And so this is one reason we want to look over the long term, because the data becomes much more reliable. But right now, I know we want to, it's like, why not invest all in S&P 500? Well, over the long run is you're going to do a lot better in small value. But we also don't know in which year is small value going to outperform or is large growth going to outperform. And that's why we're diversified. So let's look at from the years, actually let's stay on here. So large S&P 500 over 20 years, 100,000 would have grown to 300,000. Large value would have done better than S&P 500. Small stocks would have been done better. Small value would have done better. International large growth would have done worse. However, international value would have done better. And also, this is why we don't invest in just cash or money markets. Is that what your $100,000 for 20 years would have only grown to $138,000 back in 2000. So that's why it's important to invest in any one of these asset classes. You would have done significantly better than just being in cash or CDs over that time frame. So that's why it's so important to invest. And if you can look at things from a long run, it actually takes the risk out of investing because the odds or statistics are in your favor. So let's look at from the years 2000 to 2010. Like right now, it looks like we should be invested in all large growth and all S&P 500. Here's why that's not a great idea. From 2000 to 2010, if you invested all in U.S. large growth, your $100,000 would have actually lost money during that time frame. So what more than likely we're thinking is if from 2000 to 2010, let's say today's 2010, and we're looking back at this as well, let's get out of large growth because we're actually losing money. And then now what would have happened is the last 5 to 10 years, large growth was one of the best asset classes to be in. So now we're thinking, let's get back in the U.S. large growth. And maybe is it just in time for large growth while it's been going up to now start leveling out. So from 2000 to 2010, let's see what small value did. You would have tripled your money from 2000 to 2010. While remember, people talk about 2010 to 2000 to 2010 being a lost decade where we would have lost money. Well, not if you were diversified and look at if you were in small value. Let's just see large value. Large value would have done better than S&P 500. What about international? International would have done better than S&P 500. International value you would have doubled your money. And look at this, 5 of the best years were actually in international value. So while the mid 2000s is S&P 500 was not doing that well, look at 70% in international value, 63% in small value. But now let's look at from 2005 or 2015 to today. Is S&P 500 would have grown from 100,000 to 173,000. This is probably going to be the best asset class. Let's look at small value. Would have been a down year in 2015, a really good year in 2016, an okay year in 2017, a down year in 2018. In 2019, only did half as much as the S&P 500. So small value during that same time frame would have only grown to $134,000. International probably would have been lagging. Again, bonds would have been lagging. So from 2015 to 2020, looking back now, we know the S&P 500 would have been the best. Let's get some more data. I was born in 1984. So let's go back to that. Let's say 1984 to today. If we put all of our money in the S&P 500, it would have grown to 3.5 million. Now, if you happen to be lucky enough and you were able to pick which asset class would have been the best every year, you would have missed out on $1 billion. If you were able, from 1984 to today, invest your money in the best asset class each year, your $100,000 would have grown to over $1 billion. I think that's really highly unlikely that you would have been able to jump from all the way from 1984 is, okay, large value was the best in 1984, and then, so I'm going to get out of the best, I'm going to go to international, large for 2 years. I'm going to stay in international for 4 years. And then I'm coming back into the US, and then, the 1990s, we've had some great years, is now I'm going to go into bonds because I think the market's going to crash. We don't know what's going to happen in the future. What is the likelihood of you being able to do that? Or anyone out there being able to do that? Let's go back to S&P 500, 100,000, we're going to 3.5 million. Let's say if you decided not to invest, and you were just going to be in a money market account, over 35 years, your $100,000 would have grown to only $335,000. Or if you want to be in just in bonds, 100,000 would have only grown to 2 million. And here's S&P 500. Now let's see if you invested in small companies. Small blend would have trailed the S&P 500. Let's look at value. Value would have beat the S&P 500. Now let's look at small value. Would have been more than double. Again, this is the number we're looking at up here. More than double. Small value would have been more than double than the S&P 500. And this is why we're diversified and why you have more in small value. And even though the S&P 500 is doing better this year so far in small value, while it still makes sense to be diversified and have a large portion in small value. Even international value over that 35 time frame would have been a good place to be invested and done more than S&P 500. So again, I don't want to trail on too long, but we don't want to get caught up with whatever the best hot stock is or the best hot investment is for whatever time frame that we're in, a short time frame. So a couple of things to think about is, remember, the first rule of investing is to buy low and sell high. So right now, the S&P 500 is high, and it's been high for the last 5 years. Is it better to be invested now in S&P 500 when it's been high, or is it better to diversify and buy what's low, buy small value while it's low, actually? So be diversified right now, rebalance, which means if S&P 500 is up and small values down is what you do is sell what's high and buy what's low to get back into balance. I know your account is trailing the S&P 500 right now, and what I can say to that is that's going to happen from time to time. But you're still best in the long run is to be diversified. Be diversified according to academic science and the research out there that shows us over the long run, it's best to be diversified. Be patient and be disciplined, and you will be rewarded for that. Here's a couple questions to ask is, are you diversified globally? Are you rebalancing? Are you actively rebalancing right now? You should be checking in on what's your risk tolerance. And understanding, you should know what your worst case scenario is for your investment accounts right now. Don't listen to the fear of the media. Think about your long-term goals and how are you best going to reach your goals. Is it best to try to time the market and you think you can get in and out or move to the best asset class each and every year? Or is it best to remain a disciplined, diversified approach and be diversified globally? Also, most people now should have some money in some guaranteed assets, an absolute return strategy, something that's going to go up in every year so you're better able to manage these volatile times. So call me, please. Email me your questions. What I want to do is, if I can get enough questions from you, is do a town hall style, another webinar like this, where I answer all of your questions and everyone's questions so we can all benefit from the general collective knowledge. You might be asking questions that other people are thinking of that they just don't ask. So please email me your questions about this or about anything to do with your investments, and we'll do another follow-up. But I want you to have peace of mind that you're invested in an institutional portfolio that is using academic principles, whether that's 90 years of academic data, that's collectively won 5 Nobel Prizes. You're invested in over 80 countries around the world, over 22,000 different companies. You're invested in the S&P 500. You're invested in small value. You're invested in growth companies, value companies, small, large stocks, bonds. And over time, that's been the best place to be for your long-term investing success. So if you have any questions, please follow up with me. I'm here for you and to your health and to your wealth today and for the rest of your life. Thank you.